Okay. Hello, Assalamu alaikum students. This is your teacher Astabat, and today we are going to solve this latest paper. Yes. So this is AS levels accounting, Fab March 2024, paper 2, variant 2. So we are going to solve this paper today. So let's see its first question. Okay. So in the first question, we have a trial balance. Okay, and this is extracted from the V limited. It means that this is a company account question. And we have some other additional information, and we have to prepare the statement of profit and loss for the year, and we have some space for working, and also we have to prepare a statement of changes in equity. So let's start. So first of all, we have to write the revenue. So what's the revenue here? Let's see. So revenue is equal to, as you can see, that this is 997,100. So 997,100 is our revenue, and after that we have to find the cost of sales. So let's do the rough working to find out the cost of sales perfect figure. So we have this space. So as we know that in the cost of sales, we have first the opening inventory. Opening inventory, and after that we have purchases, and we have less returns, add carriage inwards. Carriage inward is not the part of distribution cost. Remember one thing, carriage inward is part of the cost of sales, because of course carriage inwards we use, like this is the transportation cost which we have to incur whenever we want to purchase the inventory from our suppliers. So distribution cost is only about the selling things. Okay, so most of our students, I don't know why, like they mixed up the carriage inwards in the distribution cost. This is not the part of distribution cost. So carriage inwards, and after that we have less closing inventory. Okay, so in the opening inventory, let's see in the question. So we have carriage inwards, which is 4,500. Okay, and we have the inventory, opening inventory, which is 47,800. Purchases, which is 5,223. Okay, and we have returns also, which is equal to 5,100, and the closing inventory, which is valued as 49,500. 49,500 is a closing inventory. So let's find out, and there is nothing additional information is about, like, and there is no adjustment for the cost of sales, because I have read this question, so that's why I know. So in the opening inventory, first of all, we have the first thing, which is 47800. This is our closing inventory, and purchases are 522,000. Returns are is equal to 5,100, and carriage inwards is equal to 4,500. So carriage inward is equal to 4,500, and closing inventory is equal to 49,500. So 47,800 plus 52,000 minus 5,100 plus 4,500 minus 49,500. So it would give us the cost of sales, which is equal to 519,700. So this is the cost of sales. Okay. So now let's see the distribution cost. Okay, so as we can see that in the trial balance, we have a distribution cost, which is 30,700. Okay. And there are maybe some other adjustments. Let's see. Okay, so basically carriage outwards is the part of the distribution cost, which I have told you that all the cost, all the selling expenses means, for example, if you are maybe sending the goods to your customers, so the transportation costs which you have incurred in that matter, it means the carriage outwards. So this would be the part of distribution cost. So that's why 8700 would be the part of distribution cost. Okay. And let's see the other. So if you can see that we have the wages of sales staff. So wages of sales staff is also the part of distribution cost, 38,300. And let's see the other, maybe the other adjustments. So this is the closing inventory. We know about it. Distribution costs include a prepayment of $6,000. So if this is a prepayment, so it means that we have to deduct it. At 31st December 2023, rental income of 3,000 had been received in advance. So this is the income which is not the part of our distribution cost. This would the part of administration expenses. Provision should be made for the depreciation for machinery and equipment at 20% per annum using the reducing balance method. Depreciation charges should be allocated 60% to administrative expenses and 40% to distribution cost. So it means that first of all, we have to find out its depreciation, and after that, we will be multiplying its total depreciation with the 40%. At 31st December 2023, office wages of 5,800 was due but unpaid. So this is the accrued. This would be a liability, and this would be because this is a office wages, so that's why it would be the part of administrative expenses. In six, debenture had been issued on 1st October 2023. The first interest payment is due on 31st March. So this is your finance cost. Tax for the year ended 31st December 2023 is estimated to be 27,900. So this is your tax, which will be deducting after finding the profit for the year. Okay. So first of all, let's see the distribution. Okay. So first of all, I think I should write the cost of sales here. So the cost of sales was 5,19,700. Okay, so let's find out the distribution now. Distribution cost. So in the distribution cost, we have first of all the distribution cost, which is 30,700, and we also, if you see the carriage outwards, is also a part of our distribution, and this is 8,700, and also the wages sales staff. The wages for the sales staff was 38,300, and the distribution cost which was prepaid, and that was $6,000. So prepaid, it means that this would be our asset and this should not be the part of distribution cost. It means the expenses part. So distribution prepaid is equal to 6,000. So this should be deducted. And after that, we have to find out the depreciation on furniture and equipment. So depreciation of furniture and equipment. Okay, so let's see that what was the depreciation policy. Okay, so as you can see that provision should be made for depreciation of furniture and equipment at 20% per annum using the reducing balance method. So this is a reducing balance method. It means that we have to apply its 20% on the net book value. Okay, so now let's see what is its net book value. So its net book value is, if you see the carrying value is written here for furniture and equipment, which is 9 lakh 56,000. So let's find out the depreciation on this. Okay. So 9 lakh 56, 9 lakh 56,000 multiply 20%. So whatever the answer will be, just multiply it by the 40%, because 40% was the part, the total whatever total depreciation, it's 40% is the part of distribution cost. So this would give you 76,480. So now add all the distribution cost, carriage outward, wages, sales staff, and deduct the distribution prepaid. So now we have the total distribution cost, which is 1,48,180. Okay, so this is the distribution cost. So now let's see the administrative expenses. So if you see that the administrative expenses in the trial balance, which is 17,200, this is the administrative expenses, 17,200. So now let's see the other. So if you see that we have wages for the office staff, I guess. Yes. So this is also the part of administrative expenses, wages of office staff, which is 49,300. But if you see that there is adjustment here, and the adjustment is for the office staff wages, is that at 31st December 2023, office wages 5,800 were due but unpaid. So this is unpaid. So it means that we have to add this in the trial balances wages. Okay. And we have the depreciation again. So this would be the administrative expenses. And we have depreciation also. Okay, so in the administrative expenses and the trial balance, administrative expenses, which is in the trial balance, and this is 17,200. And we have wages of sales staff, and this is in the trial balance, which is 49,300, plus the accrued was 5,800, and this is 55,100. And we have the depreciation. So for the depreciation for equipment of furniture and equipment, so the net book value would be same, which is 956,000 multiply 20%, multiply 60%, because 60% was the part of the administrative expenses. So this is giving us the answer, which is 114,720. So this is the administrative expenses part. So altogether, if you add these three, so you have the administrative expenses, which is 187,020. Okay. So now let's see the finance cost. Okay. So if you see that the finance cost is that debentures had been issued on 1st October 2023, and the first interest payment is due on 31st March 2023. Okay. So basically, the first payment is due, which we supposed to pay on 31st March. But if you see that whether we pay this after 3 months, 4 months, or maybe 6 months, but if this is a part of your current year, it means that your year-end expense, so we have to add it in the current year's income statement. It means in the profit loss statement. So that is why, if you see, we have different other bank interest payment, I guess. because our year is ending on 31st December. If you see, the 31st December would be our year end. Okay. So it means that October, November, and December. So we have to pay the interest for 1/3 month. It means that only for 3 months. But we have some other things. If you see here, that the debentures are 240,000. Okay. And we paid the bank loan interest, which is 2,600. So this would also be the part of the finance cost. So let's see. Yeah. So firstly, we have the bank loan interest, which is equal to 2,600. Okay. And we have debenture interest also. And the debenture interest was 8% on $240,000. Yes, 8%, multiply to 40,000. And since we have to pay the interest for 3 months, so 3 divided by 12. So this would give you the answer, which is 4,800. So altogether, we have the finance cost, which is 7,400. Okay, so now just fill all the empty spaces. Okay, so what would be our gross profit? So simply just deduct the cost of sales from the revenue. So we have the gross profit, which is equal to 477,400. And we have to see the other income, but for before that, I think we should write all the distribution cost and administrative expenses, but we have find it out yet. So in the distribution cost, we found that 148,180 was the cost of distribution, and administrative expenses was 187,020, and the finance cost, which is 7,400. So now let's find out the other income. Okay, so if you see that in the other income, we have only 13,300. This is the other income, 13,300. But if you see that, if you remember that we have seen the adjustment for the rental income, and this is the rental income adjustment, which is at 31st December 2023, rental income of 3,000 had been received in advance. So it means that we have the rental income, which is 13,300, minus 3,000, because this was in the advance. So that's why we should not consider it for this year. We cannot say that this 3,000 would be the part of our this year's current year's income statement. So that's why we have to deduct 3,000 from here. So this would give you 10,300 answer. Okay, so now let's find out the profit from operations. So GP minus plus other income, minus distribution cost, minus administrative expenses. So we have the profit from operations, which is 152,500. It means that 1,52,500. And now deduct the finance cost from the profit from operations. So we have the profit before tax, which is 1,45100. And now let's see that how much taxes we supposed to pay. Okay, so if you see the text, the adjustment, not adjustment basically, the tax amount is written here. The tax for the year ended 31st December 2023 is estimated to be 27,900. So this is our tax. So we just simply deduct this tax from the profit before tax. So minus 27,900. So our profit of year would be 117,200. So this is the profit for the year. Okay, so we have completed one part of this. Okay, so if you see that we have the other things to do, we are basically supposed to make the statement of changes in equity. Okay, so for the statement of changes in equity, if you see that we have some balances. Okay, so first of all, if you see that we have the share, we don't have any balances in the share capital, share premium, but we have the balances in the revaluation reserves, retained earnings, and we are going to total it. So balances on 1st January 2023 and balances on 31st December 2023 is written here. Okay, so now let's try to find out. Okay, so if you see that at the start of the year, sorry, at the end of the year, we have um, the share capital, which is 1,000,000, and the ordinary shares was 4,000,000. So this was our like the end of the year share capital, and we have also the share premium. Okay, so basically the problem in this question is that we don't have the balances, the first January 2023 balances in the share capital and in the share premium. But we have the balances at the end of the year in share capital and in share premium. Okay, so first of all, we have to find out the balances of the share capital and the share premium at the start of the year. So if you see that in the question, if you see that on 1st September 2023, a right issue had been made for one ordinary share for every three ordinary shares. It means that if you have the three ordinary shares, so you can have one ordinary share. So automatically, it means that every like each shareholder would be having four shares after issuing this right share. Okay, so if you see that we have the closing balances, we have the closing balances of this statement of changes in equity, which is 1 million and 215,000. Okay, so it means that at the start of the, if you want to find out the share capital and the share premium, so we have to multiply 1 million by the 1 over 4, because if you basically giving one share for one right share for everyone who is holding three ordinary shares, so of course it means that each and every person would be having four shares, four ordinary shares. Okay, so that's why we have to find out that what would be the share capital and share premium if we multiply divided by the 4, 1 over 4. Okay, so if you see, mm, not basically 1 million, let's see its total shares, not the 1 million, because 1 million is the closing balance. Okay, so let's see in the question. So if you see that in the question, the share capital, which is basically 1 million, was not a number of shares. The number of shares is 4 million. Okay, and the share capital is 1 million. So we have to multiply the 4 million ordinary number of shares with the 1 over 4. And reason why I have told you this one. So let's do some working here. Okay, so 4 million multiply 1 over 4. So if you are multiplying it 1 over 4, so you have the number of shares, which is 1 million. Okay, and if you see the question again, that the share price of each share, which is 0.25. So let's multiply it with the 0.25, find out the share capital. Multiply 0.25. So you have 2,50,000 share capital. 2,50,000 share capital. So let's write it here. When we do the right issue, so at that time, we increase the share capital by 2,50,000. But if you know that in the right issue, we can sell uh, our share maybe on the premium price. Okay, because if whenever you are whenever you are selling your right issue, so at that time you can in your share capital is also increasing, but with that your share premium is also increasing. So if you see that the share premium for the right issue was 0.05. As you can see in the question, that the issue was made at a premium of 0.05 per share. The right issue was fully subscribed. So it means that now we have to find out that what would be the share premium when we issue shares. Okay, so the number of shares which we issued, which is 1 million, and the premium price was 0.05, I think it's 0.05. So 0.05, so you have 1 million. Okay, so you have 50,000 dollars share premium. So this is a share premium. Just remember one thing, that I didn't solved these values for the balances at the start of the year. I just find out this value uh, when we basically sell our right issue. Okay, so this is a share premium, and this was our share capital, which we raised when we sell our right issue. Okay, so write it here. So $250,000 and $50,000. Okay, so if you see that the closing balance shows us that we have the share capital, which is 1 million, and share premium, which is $215,000. So if you deduct your right issue, which is $250,000 as share capital from the 1 million, so you can automatically get your opening year balance. So 1 million minus $250,000. So your opening balance would be $750,000. And if you want to find a share premium at the start of the year, so this is the premium which you find for the right issue. Okay, and this is the year end balance. It is $215,000. So if $215,000 minus 50,000, so you have $165,000 share premium at the start of the year. Okay, uh, so we have done with this part. So let's see the other parts of this question. So if you see that there is one more entry here, and value reduced by $60,000. So if your value is reduced by $60,000, so you have to deduct it from the revaluation reserves. So revaluation of property. So we have to deduct this because it has reduced. Okay. And yes, so let's see the other one. And we also have to add the profit for the year. So if you see that we have the profit for the year, which is 117,200. And we have one more thing here which we have to deduct is the payment of dividend. As you can see that your payment of dividend is uh, 37,500. So we have to deduct this thing from the SOSI. It means the statement of changes in equity. Okay. So the dividend paid and the profit for the year. So profit for the year, we have to add in the retained earnings, 117,200. And dividend paid, we have to deduct from the retained earning, which is 37,500. Okay, so let's total it. So in the total, we have one, 4,900. In the right issue would be the total of this would be the 3 lakh. And we have to deduct the 60,000 from the total. And 37,500 would be less. And this would be add. So finally, we have uh, the retained earnings, which is 253,700. And this is 146,800. Okay. So this is our statement of change in equity. Okay. So now let's see the C part. So in the C part, the first question is that that directors state two factors that directors should take into account when declaring a dividend. So first of all, whenever you are going to uh, declaring a dividend, so first of all, you have to see the current year's profit. And the number two is availability of sufficient cash. Okay. So the second question is that directors wish to improve the company's performance. They are considering two options. So option A is the delaying payments to credit suppliers by an extra 8 days. And option B is switching to a new supplier who is prepared to offer a trade discount if large orders are made. So we have to give the advise the directors which option they should choose. Justify your choice by considering the effect on both profitability and liquidity. So it means that we have to talk about the as per the profitability and the liquidity for both options. So if we see the option A, so for our profitability, because we are delaying the payment to credit suppliers by an extra 8 days, so what would happen? It may worsen the relationship, okay, with some suppliers, and it resulting in less advantageous prices. It means that maybe you will not be getting any discounts. Okay, and from the liquidity perspective, the delay in paying suppliers will improve cash flows. Okay, and some suppliers may withdraw credit terms, worsening the cash flow position. And if you see the option B, and which is about the switching to new supplier who is prepared to offer a trade discount if large orders were are made. So if we talk about its profitability, so we can say that it will improve profitability as cost of sales reduce. Okay, and possible reduction in quality. This is the disadvantage, and the maybe supplier will prove reliable. It means the delivery times, resulting in delays and possible loss of customers. And if we talk about its liquidity, so it will improve cash flow as cost of purchases reduce. So you can advise whatever you want, like it should be logical though. Okay, so as you can see that we have the question number two. So in the question number two, if you see, I have already solved it. That Zanab uses a straight line method of depreciation for business vehicles, and non-current assets of the business is included two vehicles. So we have two vehicles and its cost is 26,000 and 28,200. This was purchased on 1st January 2021, and this was purchased on 22 for September. So vehicles are depreciated by 20% per annum. Depreciation is calculated on a month by month basis in the year of purchase. No depreciation is provided in the year of disposal, and the financial year ends on 31st December. So first of all, we have to prepare a general entry to record a depreciation charge for the year ended 31st December 2022. A narrative is not required. So first of all, we have to see that how much depreciation we have. So for the vehicle one, if you see that it was purchased in 1st January 2021 to um, 31st 2022, so it would give you the 1 year's depreciation. So just apply the 20% on the cost. So we had a 5200 depreciation for the vehicle one. And for the vehicle two, if you see that it was purchased on 1st September and the year is ending on 31st December, so it means that there is only 3 months, um only 3 months, like we have to apply only 3 months depreciation. So 28,200 multiplied by 20%, multiplied by 1/3 is equal to 1880. So altogether we have 7080 depreciation for the both of the vehicles. So whenever we are charging the depreciation, so we have to debit the profit and loss account, and we have to credit the provision account. Okay, so this is the very simple entry for the this question. Okay, so let's see the other one. So in the B part, where the provision for depreciation vehicles account for the year ended 31st December 2022. So provision for depreciation vehicle account. So first of all, we have balance BD, which is because we are preparing for 31st December 2022. So it means that we should talk about its first, it's the starting year balance BD. So this 5200, if you see that this is the depreciation for vehicle one, because it was purchased in 1st January 2021 to 2022 31st December. So it means that it would give you $5,200 of depreciation. Okay. And but from the profit and loss, we will be writing 7080, which is basically the total depreciation for vehicle one and for vehicle two, which I have calculated here because I have already given much explanation about that how to find a depreciation for both of the assets. Okay, so we know that in the provision profit and loss, we have to transfer the vehicle one and vehicle two depreciation. Okay, so this is 7080. So this is balance CD and just balance your provision account. So we just did it. And now let's see that on 15 Feb 2023, vehicle one was disposed of at a profit of 4,200. Okay, so this was happened on 15 Feb 2023. So it means that we should not charge the depreciation for 2023. Why? Because in the question they have told us that no disposal, no depreciation for the disposal year. So we basically earn a profit. We gain on disposal, which is 4,200, and proceed were paid into a business bank account. So basically we don't know that what amount we should transfer in the bank account, because there is nothing like information here. So but we can find it out. How? Because we know that it's um, provision for depreciation would be 26,000 minus 1040. So how I calculated the 1040. So you know that we have purchased this in 2021. So 2021 depreciation was 5200. Okay, that was 5200. And for 2022 it is again 5200. So 5200 plus 5200, this is equal to 10400. But in 2023 we sold it out in 2015 fab. So we can because the year is ending on 31st December 2022. Okay, so we can maybe charge the depreciation for 3 months, but the reason is not the 3 months. Basically this is because sold out on the 15th fab. Yes, we can charge the depreciation for 2 months, sorry. But the thing is that we have a depreciation policy that we cannot charge the depreciation in the disposal year. So that is why we will only calculate a 2 years depreciation. Okay, so that's why for this provision for depreciation would be 10400. Okay, and we know that in the vehicle disposal account we have to credit the vehicle cost and debit the vehicle disposal. So as you can see that I have did it. Vehicle cost 26,000 is correct because we just sold out this asset. That is why we have to credit our asset account and debit the vehicle disposal account. Okay, so basically we gain on disposal, which is $4,200. So whenever we gain on disposal, so our income statement would be credit and vehicle disposal account would be debit. That's why we'll be writing it here. Profit and loss statement is equal to 4,200. So this would be credit and vehicle disposal account would be debit. But we don't know that what is the bank entry because we don't know that how much amount we get. So whatever the amount we get, because this is the profit, so it means that we get the amount above its net book value. So that's why we have to find out its net book value first. So net book value is equal to cost minus AD, means accumulated depreciation. So cost was $26,000 and AD was 10400. So as you can see that this is 15,600, but we, because this is the net book value of your vehicle, but because we gain profit, because whenever the person, or you can say that to whom we are selling our asset, so that person would be giving us the 4,200 amount and plus its net book value. So net book value was 50,600. Okay, and because we gain on disposal, which is 4,200, so we have to add the net book value and the gain on disposal. So we have 19,800 which we received in our bank account. So because since we received this amount in the bank account, so bank would be debit and vehicle disposal would be credit. Okay. Okay, so our first, the D part is that state one reason why it may be better to use the reducing balance method of depreciation for vehicles. So we can say that for this question, we can say that annual charge more closely reflects the loss in value of motor vehicle. Okay, and we can also say that earning power of motor vehicles diminishes over time. And the second, the E part is that explain two accounting concepts which apply to depreciation. So we know that we can say that matching or accruals concepts, which ensures that costs of the assets are matched with the benefits received in the same accounting period. And the number two is, we can say, the prudence concept, because prudence concept, it ensures that profit are not overstated or losses should be provided for as soon as they are recognized, because depreciation is also a kind of expense for us. That's why we have to record it. Okay, so now let's see the third question. So the third question is that Rahul owns a retail business. He has not maintained full accounting records. He is able to supply the following information about the financial year and 31st December, 31st January 2024. So value of inventories. So we have, this is the opening inventory, this is the closing inventory. Okay. So Rahul sells goods on so as to achieve the gross profit margin, which is 40%. And the usual rate of inventory turnover is 9 times a year. Calculate the revenue for the year ended 31st December 2024. So we have to calculate the revenue. So first of all, we have to see that we can use inventory turnover formula here. So inventory turnover is equal to cost of sales upon average inventory. We know about it. Okay. So basically, we are trying to find out the cost of sales. So cost of sales would be there is equal to inventory turnover was 9 times. So 9 multiply. And how did I find 2060? Basically, I have deducted the opening inventory from the closing. So and divided by the two, because you can find out the average inventory by doing this. So average inventory is 20,600. Okay. So this would be equal to 185,400. So this would be the answer for cost of sales. Okay, so this would be the cost of sales, but if you see that we can find out the revenue, but the thing is that we have the margin. But for the cost of sales, we have to find out the markup. So for the markup, we can convert it into the markup. Okay, so the markup would be 100 minus 40 over 100 minus 40. So this would give you 40 over 60. And it means that this is a 2 over third part of the cost of sales. So 185, 400 multiplied 2 over third. So this is your GP, which is 123,600. And we have to add the GP with the cost of sales in order to get the revenue. So this is the revenue 309,000. So we just find it out the revenue. Okay. So now let's see the other question. Okay. So the other question is that Rahul has not kept a record of his cash drawings during the year end 31st January 2024. However, the following information is available concerning the cash transactions. So these are the 5 transactions. So on 1st Feb 2023, there was cash in hand, which is 840. For this, basically, we can make the receipt and payment account. So it means that this would be on the debit side. It means that it would add uh, into the receipt and payment account. Cash sales accounted for 70% of all sales. So the sales was this. So you just need to multiply it by the 70%. So 3,09,000 multiplied by 70% is equal to 216,300, which is our cash sales. So we know that cash sale would also add in the receipt and payment account because this would be on the credit debit side. Okay. And bank statements recorded the total cash takings of 187,300 for the year end 31st January 2024. However, 31st January 2024, there was a cash takings banked but not yet credited 3,800. Okay. So basically, we basically banked our all cash takings, which is 187,300 and 3,800. So we know that whenever we maybe deposit our all cash takings in the bank account, so this would be um, you can say that the credit entry on the receipt in the receipt and payment account, it means in the cash book. So that's why we would be deducting it, because this is the credit entry. Cash, you can also make the receipt and payment account, but I just want to save the time. Cash was used to pay a part-time assistant wages of 320 per week. The assistant worked for 44 weeks during the year ended 31st January 2024. Okay, so cash is $320 and per week. Okay, and your assistant worked for 44 weeks. So just multiply 44 by 320. So we know that these are the wages. So wages would also be carried in the receipt and payment account. So 320 multiply 44. So this is 14,080. Okay, and at 31st January, cash in hand was 1830. So we know this is the closing balance CD. So this would be come under the credit side of the receipt and payment account. Okay, so this would be the on the debit side, and this would be the credit side. So you can also find its difference. Okay, and you can maybe add this difference if this is the positive difference. So if you see that we have at the end of the year we have 1830, and at the start of the year we have 840. So we can find its difference. So if you see that its difference is positive, so it means that our cash has increased during the month. So that's why we can add this. But the question is that we have to find out the cash drawings. So now it is very simple. If you see here, cash sales would be added because this would be coming under the debit side. So we have to add this cash sales bank, our cash takings we deposited into the bank. So that's why we have to make its current entry. That's why we are deducting it. Whereas is also a current entry, so that's why we are deducting it. And the debit balance at the start, which is 840, at the end of the month, which is I think, yeah, this is 1830. So it means that your overall cash is increased, so that's why we have to add it, which is 900. So altogether, whatever the answer you will find, this would be a drawing. Okay, but you can also solve it by making the receipt and payment account. So now it's your choice. Okay, so we have some additional information that Rahul's accountant has suggested that he should start keeping full accounting records and that he should use an accounting software package. So state two ways in which Rahul benefit from the accountant's suggestions. Okay. So first benefit would be that it can help to identify the errors. Okay, and the second advantage can be that less expenditure on accountants fees, because now we have the software. Okay, so now we have the second question is that we explain two possible reasons for not accepting the accountant suggestions. It means that we should not accept the suggestion that we should install the software. So we can say that maybe there will be an additional cost. Okay, and these costs could include the equipment and software programs, and the cost of paying someone to maintain accounting records, and training costs for Rahul, because of course if you're purchasing new software, so it means that maybe you have to give the training to your new employees, and should he wish to use the accounting package. And the second thing we can say, the second reason is that Rahul may feel that he does not need any more detailed information about the business and is satisfied with the how business operates, and the rewards receives does not have the time or skills to use an accounting software package. So these are the two simple reasons you can do that. So now we have the question number 4 finally. So question number 4, if you see that K Limited uses the absorption costing, one of its factories and product manufacture in this factory goes through two production departments, cutting department and the finishing department. The following budget information was available for the year end 31st December 2023. So this is the overhead absorption rate. Normally, we have to find the overhead absorption rate, but in this question, we don't need to find it out. But yes, there is no budget overheads given. Labor hours for cutting department, this and this. So it means that cutting department is the capital intensive, because as you can see that machine hours equal 22,900. And finishing department, if you see that it is the labor intensive, because labor hours is more than the machine hours. Customer placed an order of 250 units in November 2023. The following budget information is available about the production of one unit. So we have this information. So per unit, we have the direct material, which is 17.28, direct labor, which is 1.2 hours for at 11.50 per hour. And finishing department, 3.1 hour at 11.50 per hour. Machine hours cutting department, which is 2.2 hours, and finishing department is 1.4 hours. Selling price are set to achieve a profit margin of 40%. Prepare a statement to show the total selling price for the customer's order. So first of all, direct material is very simple. I am just going to find out, first of all, the per unit cost. So 17.28 is a direct material, and the direct labor, we have two departments. First one is a cutting department. Okay. So if you see that for the cutting department, in the cutting department, workers are working for 1.2 hours and you're paying 11.50 per hour. So this would give you 13.8. For finishing department, 3.1 are basically invested and you're giving $11.50 per hour. So this would give you 35.65. Okay, so now let's see the overheads. So if you see the overheads, so because also the machine hours, so in overheads, we in the cutting department we are basically investing 2.2 hours to produce one product, and its overhead of the generator is 3.62. If you see in the question, this was 3.62, and for finishing department this is 2.34. So cutting department 2.2 hours multiplied by 3.68. This is 7.96. For finishing department, this is 3.1 hour multiplied by 2.34. This is 7.25. So this is the total cost, which is 81.95. But we have to find out its selling price. We have the cost. Okay. So what we have to do is, if you remember that we are charging 40% margin. So it means that we can convert it into the markup. So what's the formula? Markup over 100, sorry, margin over 100 minus margin. So 40% is the margin, 100 minus 40 is equal to 40 over 60. So if you multiply this 40 over 60, so maybe you will get the answer for in decimal form, but it's better if you write here the 2 over 3, because 40 over 60. So it means that uh, 22s are 40 and 23s are 60. So 2 over 3 is our answer. So 81.95 multiplied 2 over third. So we have 54.62. So 54.62 is basically our selling price. So you have to add this into with the cost. So selling price, how can I get the selling price? This is the margin 54.62, and we have to add this margin with the cost. So we had a selling price which is 136.57, and our total selling price would be, because the demand from the customer is 250 units, so you have to multiply it with the 250 units. So 136 minus 57 multiplied by 250. So this is the total selling price.